Okay. No, I take a point that the Indian market started falling, got an acceleration in their fall on Friday after the Singapore news trickled in, indicating a certain uncertainty about the Homo sapiens conquest over the virus. Okay, joining us to discuss, of course, more immediate matters, financial matters, are two veterans from Dalal Street, Aditya Narain, Head of Research for Institutional Equities at Edelweiss, and Manish Sonthalia, the Head of Equities PMS at Motilal Oswal Asset Management. Well, first let me invite Aditya Narain. Thank you very much for joining us. Well, Aditya Narain, one thought that one had seen the worst at 7,500 and the markets, this pendulum had swung too much. But, even after the recovery, it has been a slow, low grind. Do you think the markets are going to remain fairly skittish for some time now?
But I do think the beginning to enter a kind of a consolidation phase as far as the market is concerned. In the initial runoff, there is a kind of a capital that is happening.
No, Aditya, we are not able to get you. I think we will have to put you on phone if the Skype works this way. We'll do one thing. We'll just redial in 1 minute and get back to you. Well, in the meanwhile, let's look at other things that have happened this week. Do we have the auto sales numbers? That I think will be something to look at. If Sonia is ready with those numbers. Okay, we don't have. All right, then the other thing other than auto sales, which were in the news, I guess, were the finance stocks?
Oh, absolutely, Lata. I mean, the Reserve Bank of India has sent a circular on NBFCs, and this is important because for the bulk of the week, NBFCs and private banks less so, were all collapsing. But I think we've got something from the RBI.
Actually, it's not quite a circular from RBI. We have only the old announcement of RBI made last week that moratorium is available. After that, we had the Indian Banks Association put out an FAQ and SBI put out an FAQ. And there they've said that this scheme, moratorium and working capital easing, is not available for MFIs, NBFCs. Now, there has been a lot of back and forth on this because some of the NBFCs said that they have actually got letters from their bankers saying this is available. Indiabulls showed us letters from PNB and from Indian Bank. But if you looked at the question number 14 of the Indian Bank's FAQ and question number 13 of the SBI FAQ, it is very clear that they have said the scheme is not available to NBFCs. So I had to telephone both these top officials of RBI and SBI, and they said their intention was that this is for the real economy. The moratorium as well as the working capital easing working capital requirement, raising of working capital limits. This is not for NBFCs. For NBFCs, it is for financial intermediaries, as they call it. It is the long-term repo. The targeted long-term repo is the instrument through which RBI will give money to banks, and banks have to invest that money in CPs, bonds, debentures, issued by anyone, but largely, you all know that outstanding bonds and even fresh bond issuances come largely from NBFCs. So liquidity will be provided to financial intermediaries, and moratorium is provided for the real economy. That seems to be the understanding of the regulator. It's slowly sinking in, with several people saying that they will wait for more clarifications from RBI, but that was an added negative perhaps for the NBFCs.
Okay, let's get you some opinion now, and we'll get to our local market experts in just a bit. We spoke with Kenneth Rogoff, former chief economist, IMF, about the economic impact of COVID-19 on the United States, as well as on emerging countries and their respective economies. Listen in to some of that chat.
Macroeconomic response has been very strong. What the Federal Reserve has done, thank goodness we still have an independent Federal Reserve, which some people don't want. And the $2 trillion stimulus, it's not going to be the last, but absolutely excellent. So our macroeconomic response is excellent, but it's a little bit like you're in a war and you're not doing a very good job fighting the war, but you're doing a good job maintaining the economy. You really need to do better on the war. unfortunately, there are many emerging markets where the situation's very difficult. Their growth had been slowing. Their debts had been rising before this. The World Bank warned about this at the end of last year. They are not going to be able to tap markets. In fact, if you look at capital outflows from emerging markets, they're racing out at a rate I don't know that we've seen since the last major crisis, maybe the Asian debt crisis. Maybe this is worse, though. So no, it puts governments in a very difficult position, and that's all the more reason I think the advanced economies have to not just look inward, but look to help the neediest emerging markets and developing economies. This is a global problem. This is not just one country's problem.
Okay, I hope we are better able to connect with our guests now that we have heard Kenneth Rogoff. Let's go to Aditya Narain of Edelweiss and Manish Santalia of Motilal Oswal. Okay, Manish, let me try my luck with you. The markets, after a recovery from 7,500, have once again tumbled. What is your sense that you will wait before you buy?
Lata, I think, except for the financials, the rest of the market are doing fine. I mean, they are almost at what seems like bottom trough valuations. Of course, it's a different play on the financials per se, which I think is going to underperform going forward as well. But apart from that, the autos, the IT pharmas and the consumer name seems like they are at very good levels to buy. So we are buying them.
Financials, even the top tier ones will underperform, in your opinion?
I would believe that, leave behind the HDFC Bank and the Kotak Bank and the ICICI Bank, the rest of them are likely to underperform because, given the fact that if you have, let's say, 2 months of, lockdown, which means that over the period FY21, the 12 months is actually going to be 10 months of growth. And that would broadly mean that, even if you assume that it's going to be a zero growth sort of a play, and base case on FY21 is a 20% degrowth is what we figure out the other bank per se. From that point of view, I think, the men will be separated from the boys. And within that, the HDFC Bank, the ICICI and the Kotak will slightly fare better than the rest of the bank.
Well, I think we have Aditya Narain as well with us. Aditya, how are you approaching the market? Are you buying at all? And if you are, would it be the classic defensives, pharma, FMCG?
The way, Lata, I see the market is that, you had, and I was saying this earlier, that you had a little bit of a capitulation as far as the broader market is concerned, right? And this is something you've seen with previous crises also, that there is a short period when stocks come off very, very dramatically. Initially, they're not discerning. After that, there is a little bit of discernment. But there is this period of very rapid fall. Quite honestly, I think that period is now more or less over. So what you're going to get is a period of consolidation. But this period of consolidation, I think, can go on for quite a while. Minimum would be 3 months. It could be extended well beyond. So at some level, I don't think there is any hurry to go in and buy. Nothing, I think, will materially run away. You might have the odd stock where there is a certain amount of extreme mispricing because of flows. But X of that, I think it is a period where you are going to see stability, but you are going to get into a position where you have the option of, reading through a business and then buying, with much greater conviction rather than when you're seeing price action and you get too excited about it.
So in a way, Aditya, what you're suggesting is broadly where prices are, they are aligned with fundamentals, with earnings. And there is no real large-scale mispricing, as Manish seemed to be suggesting. Yeah, go on.
No, my point was that you will have stocks which have a certain amount of mispricing, firstly. Secondly, in terms of, are they okay in terms of valuations or in terms of growth? I think that's a call that's very hard to make at this point in time. I think the the big adjustment for the slowdown in the economy and the risks that have built up with it, I think that has happened. But how it unfolds going forward is what you have time to think about. Because at this point in time, there'll be conventional thinking which says there'll be a V recovery, or that you wait for 3 months and it'll go up, or, finally business will revert to more or less the same structure. It's a question of timing. My sense is that a lot has effectively changed. You are going to get this period of time where stocks will just move up and down a little bit, as I said, a few stocks which are materially mispriced and largely because of flows. But otherwise, it's only the brave who can sit today and say there isn't going to be a second drop in terms of the virus itself, or that the economic response, both to the shutdown and to some of the compensatory efforts that the government and the RBI make, that path is actually laid out clearly.
Okay. Manish, what are your views on the length of the correction? Have we more or less, even if we have more or less corrected in terms of amount, first of all, would you agree to that in terms of amount we have corrected enough? What about length? Can this go on? Because we are not even sure that the contagion has peaked.
I think that FY21 numbers are broadly discounted in the prices, so nobody is expecting any great numbers for FY21. I think the whole point is going into FY22 and beyond, is there some sort of a visibility? So let's say the auto pack, we have the Marutis, Eisers of the world which are tumbling like nine pins. But if you look at from where we are now, FY22 for the next 3 years, we're looking at something like a 25% sort of a CAGR growth in almost all the auto needs. So, even if we, let's say, figure out that, second half of the year we will be in for a U-shaped recovery, not exactly a V-shaped recovery, things would only get better in Q4 and beyond. There is ample value in the markets, and 7,500 seem to suggest that, we are broadly at valuations where we were in 2008-9, market cap to GDP and prices to earnings or whatever, price to book, whatever matrices you may look at it. So I understand these are unprecedented times, and there could be some extended selling by FPIs which could leave the benchmark stocks lower. But that is not to say that the value is not there. The value is definitely there, and broadly we are more towards the bottom rather than anywhere in between.
Okay, more towards the bottom, both in terms of price and time. Manish.
Yeah, I mean, if you were to get some sense of when the lockdown is going to happen, and I believe this 14th, and after that there could be some 10 hotspots in the country where travel would be restricted, masks and sanitizers are the order of the day. This will continue for the next 1 year. You have restricted domestic travel, almost nil international travel. These would be, the video conferencing and Skype calls and Zoom calls would be the new way of doing business, etc. But that's not to say that production is not going to begin, or say, travel and movement of goods, etc. will not happen. My sense is second half of the year you should be in for good recovery. But the first 2 quarters is broadly washed. And I think the markets are broadly pricing in that.
Well, finally, can we get from both of you the top stocks or sectors that is in your shopping list? You go first, Aditya. What are you buying?
Yeah, so from our side, I think, in an environment like this, I think you play for, particularly as I see it a market that's going to consolidate over the next 3 to 6 months. Plus, I see structural change in the market going beyond. So the easy way to play it in this environment for me is to play, I think, stories that structurally benefit. And so to that extent, there will be telecom where Bharti will lead. There will be IT services where someone like Infosys will lead. And I would think it's a safer way to do that. I think in terms of stock specific, I think you also end up getting probably banks where fundamentally there will be a consolidation. And so you will have some of the larger ones looking particularly attractive. But their response over the near to medium term, I think will be muted, because they are going to take, the socializing of losses that happen in the economy. At some level, they will have to bear some part of it. So far, it's very clean for them. but I think they will have to bear some of the costs there.
Out of time, Manish, top two stocks.
I think, as a pure contra play, if you were to look at the sectors currently, the auto pack as a whole just offers too big a margin of safety if you were to have a 2 to 3 year time horizon. And today we are in a risk-off environment, and one plays for earnings visibility with lower risk. I think the ITs and pharmas of the world would perfectly fit into that.
Okay, fair enough. ITs and farmers of the world. Appreciate your time, Manish and Aditya. Thank you very much for being here on the show, taking stock. Have a good weekend. Locked in, of course, but we'll see you back on Tuesday. Monday, of course, remember, is a market holiday, but we will, of course, be coming to you, tracking global markets and getting you opinion. Time for a quick break here, but when we come back, we get you a quick technical check as well.